Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, April 9th, 2025. Just going to do a semi-brief update on the markets. I want to just kind of give you my thoughts, not just, where we are, but most important, as always, where we're going forward, or most likely. The markets are like a chess game. Today you just have to kind of play three steps ahead. And so, all right, so we got the tweet or whatever you call it out of Trump media. Oh, remind me, by the way, I bought some DJT today. I've been trading actively. I want to get that chart out to you. I'll talk on that in a second. I'll get to that chart in 1 second. But let me turn this. I'm playing around on another monitor, trying to turn off the after-hour trade. So show where we parked today. That's it. I added a little downtrend line here, but this is the big level. Just a great resistance level. That was my final target since yesterday. If you go on the site, you know this if you've been following. No, that's today. Last post of the day, and I've been updating this one. You go to that 15-minute chart, kind of show near-term stuff. This was the trading range here. We broke out, and that was 46.14 was the final near-term target, and a good one at that. Even better now when you look at that was yesterday's chart. And again, I've updated this multiple times. 46.14 we closed at, I'm sorry, 466.14 we closed at 465.14 after hitting it. And now you can see here when I zoom out, look at that volume of price histogram bar, these red and green horizontal bars. That shows where a lot of trades have occurred. It tells me it's a very solid level. So as I said, I was active in the comment section today. A couple people asked. This is a great time, in my opinion, to either book partial or full profits, in my opinion. This is a near-term bounce target. I have some upper potential bounce targets, but we just had the NASDAQ close up 12%. Look, exactly 12%. I toggled it back. I wanted to turn off the after-hour trades in a single day. That's going to hit the record books. Point is, can we go up from there? Sure. How much more? But the odds are very low. We're very near-term overbought to go from here this morning in a single day 12%. So to me, it's a reversal point. I was fortunate enough to be able to game that pullback with near impunity earlier based on intraday active trading stuff. Juiced up my returns a little and have gone home short now because that was the target, the uppermost target I was looking for. And I think we'll get a nice pullback. Where to, that minimum right here, these resistance levels / targets work in reverse. Their resistance levels coming up. Resistance once broken becomes support. I think this is a likely one right here. We'll get some profit taken tonight into or tomorrow. There'll be a very good level. Again, you want to cover a little bit above there. That's the top of that gap from the other day, 449.94. We'll call that 450. And there's a reaction low just above it at about also 452. So somewhere around there, if you're going to attempt to pull back trade. If not, look, this is a great time. And I made a comment in the last post before this one. This is a great time to just harvest some profits if you caught any or all of this move up. And just sit back and wait for the next objective entry, especially, let me repeat, especially if you're not a very active, nimble trader. If that's not your wheelhouse, your area of expertise, now's not a good time to start learning active trading and trying to zigzag. But I will say, without waffling or mixing my words, great time to book some profits. And quite possibly also made this reply to somebody. They first asked, is it a good time to get back short again? And I'm assuming they meant long-term short. Initially, I said, we could see some more upside. And then I looked at the charts and I followed up with that. And I said, you know what? Actually, it looks like a good time to start scaling back in short. And I'm going to speak to that now, both technically and fundamentally. Fundamentally, obviously, is the fundamentals. What's going on with the trade wars, that's fundamental. It affects the macro, the bigger, longer term outlook, economic. But then there's also other things. So here's my prediction. Okay, we have the 90-day reprieve. U.S. and China are still the two biggest economies in the world, and they're still at war. They continue to up the game with but one way or another, that'll get resolved. Whether it's now or down the road, this could be prolonged. I don't know. All I know is this was positive. It was the tweet we were waiting for, and we had that explosive, quote unquote, what I said this morning, potential rip your face off if you're short rally, even if you're long. I mean, that was a hell of a ride up. So where do we go from here? That's the most important part. If you miss this, don't worry. This volatility is still high, and there's plenty of opportunities to be made. You just have to wait and take your shots and line up and take the most objective entries. So again, for those that might have caught it and aren't very active, great time to either book profits. If you trade futures or even well, it's hard, I always say, on the ETFs and individual stocks to control stops after hours, after the regular trading session, when you can't use stop loss orders, only stop limit orders, which can be bypassed. Futures, you still have, we're only on Wednesday, so you have that round the clock trading other than 5 to 6 p.m. every day Eastern, where they shut down for 1 hour. Then they pick back up at 6, continue to trade around the clock, so you can have your stops in either direction. But right now, like I said, that's it. I think at best we need to consolidate, get a little pullback. Maybe, if we get any more upside, you have the downtrend lines just above. You also have a big gap here. There's just a mountain of resistance overhead. So the easy money, in summary, the easy money has been made for right now, in my opinion. Okay, maybe wrong, but that's what I think. Now let's turn our focus to the daily charts here. Let me turn off. Let me see if just use, this is a busy board, but I can turn the levels off. I'll just hand draw it in. Okay, this is the recent trading range that we had here. We took out the 200s, consolidated for a while, back tested them. That was a gift right there, literally a gift for short sellers. That was also the peak, ran right into my preferred bounce target zone on the NQ futures and the intraday charts on QQQ. And then you got this, and now you have this, but look where this is, right back to that trading range. Again, a great time to not only book profits as an active trader, but also potentially start scaling back into longer term trades. And I'll tell you why in a second. You might say, "Oh, Randy, it's 90 days reprieve on the tariffs and markets singing kumbaya right now, except for China." But I'm going to get to something in a second. Where the market's probably going to turn its focus now, even if this trade, tariff thing stays, it's not gone away, by the way. It's just kind of a temporary reprieve, and with China, it's gotten even worse. So we'll see. But okay, so where to if not there? If we don't stop here, and again, I expect at best some consolidation, maybe a little pullback. If we're going to power through and make another run at the 200s, not my preferred scenario, but something I'm very open to if the market wants to do that. And I've said repeatedly, if the market even wants to run at the bottom of the base back there, I can see that. So this is all in the realm of possibility. But to me, it's kind of a foggy, I can see it. I'm not going to fight. I'll try to navigate. I'll try to thread the needle as good as possible, if so. So let me just move away from that for a second. Let's just look at the Mag 7 stocks and the S&P as well while we're here. Oh, wow, look at that. For the first time in a while, Microsoft overtook Apple as the largest component right there, biggest market cap. You can see it. I have them sorted by market capitalization. And Apple's been at the top for a while, but even though it had a 15% rally today, it still didn't. They still dropped it. I mean, they're both $2.6 billion companies, or trillion. I'm sorry. Okay, Microsoft, powerful, took out this trend line, so they're good. That in itself is pretty good. There's a downtrend line. I'll be honest, guys, that's not super well defined. You only have really two reactions, so it's kind of a meh. Trend line. I'm not putting a lot of weighting. This is a big level to me. That's why it was yellow, 397. So I can see a little more upside in Microsoft for sure. And I could also see this is even better resistance right here, 408.20. You can see it define this whole shelf here, this multi-month trading range, and then the breakdown and all this happened. Of course, we had trend line support there, primary trend line. So again, this is kind of my bounce target area for Microsoft, and I'm just going through the market leaders one at a time. Apple back to pretty significant resistance right here, that former fourth target zone right there, and next resistance right there. Then you have a big old gap here, so you have max bounce target on Apple right there at this point in time. If we get up there, maybe we'll set up a downtrend line as well. That might actually come in first. But I'm going to tell you right now, what I'm not seeing is evidence of a lasting bottom that I think would, take us to new highs. Would be extremely atypical. It's not the bottom I like. We traded both major bear market rallies in the 2022 drop. Both of them had nice, clean, positive divergence on the daily charts. We don't have anything other than extreme oversold readings on the daily charts right now of the indexes and most stocks. NVIDIA, I'm just showing you where everything bounced back to. NVIDIA bounced back to that potential downtrend line plus price resistance. Again, these are levels I've had here. They're in all the videos I've covered. That line's been there, 113.44, parked right on it. Mountain of resistance overhead, the 200 days, which we took out here, back tested, rejected. So again, we're coming up on that 200 exponential, 200 simple, and then even better resistance right there. So kind of a bounce target zone, if you will, for NVIDIA, anywhere from where we're at now to a little more upside. What does a little more mean? Everything's relative, guys. When volatility is high, 12%, and in a stock like NVIDIA, where the trends are measured in the high triple digits, the primary trends, if not actually quad digits there, that was a 1,200% rally. Yeah, 12% is a relatively small move, right? Does that make sense? 12% would be a massive move in treasury bonds, but a relatively, to me, minor move in NVIDIA, and just take us to the new downtrend line that started since this point here. So, all right, so you kind of see where I'm going. We're at the first point where it wouldn't surprise me one bit if that's the end, and if you blink, you miss the counter trend bounce. But I could also see a multi-week rally that takes us a little bit higher, and that could be measured still into another, double digits from where we're at, low double digits. Amazon, everything's, potential downtrend line. You can see a confluence of trades here. So you have starting to get, it's not super well-defined resistance, but enough. And Alphabet coming up on pretty decent resistance. This target zone I've had down here and the downtrend line. And so 200's up here. So everything has about another, I see max about another almost 10% bounce in the market. But actually, if you want to know if I had to short now, if I had to do anything, if you said, Randy, you can make one trade and you can't come back to the markets for another 3 months, what would it be, long or short? Oh, short all day long. I'd short here, and I'd set a stop somewhat above here. And my expectation is the market could surprise everybody and do this tomorrow, or it may zigzag on up here. And it'll probably be a bit of a grind to get up, maybe another run at the 200 days and all that. So again, maybe 10% upside, or maybe possibly zero. I would not go hard all in short just yet. Just again, let the dust settle on a big move after today. No reason to be here. I like to book gains on a big day like today, and I'm going into the day, into the evening from the close mildly short. A fraction of what I pushed it hard, because today was if there was ever a kind of push your chips in and go pretty aggressive, it's when the market started ticking up, and then boom, once it came out and I saw that it was official, the tweet had come, that was it. And there was plenty of time to get in and milk that train for all it was worth up to that target today. Meta at downtrend line resistance and the first back test of the 200 since it took them out. We took out the 200s here, and it's the first back test of the 200s, and then you have resistance above. So there's kind of collectively, I like to look at all these market leaders. There's Broadcom, right back to really nice resistance right there. Again, I'm very comfortable shorting today, and I'll see whether I probably, at some point I'll take profits and game a little. There'll be a wave of buyers stepping in on the first pullback. Whether it comes today, tomorrow, or by Friday, there'll be a wave of profit taking, and that I feel confident on. Whether we're going to go up a little first and then do it, or, like I said, most likely starts from about where we closed today up to, you can see a little more upside there if Broadcom wants to come in and test this primary uptrend line. That uptrend line, by the way, comes from the October lows. It's a super well-defined trend line. And so, like I've been saying, by every metric, a lot of stuff just broke down from the 200s and the primary trend lines. So, and those that didn't already, like the indexes, come back and test their 200s, like Meta and Broadcom, they just did right now. So that's kind of where we're at, bigger picture. And remember, don't get tied up too much in the headlines and the news. There's a big bullish falling wedge on Tesla. So Tesla, if it breaks it out, there could be more. I keep talking about what I think, where I think the upside's limited, but I'm open to everything, and I'll take it one day at a time. So let's see what happens tomorrow. Again, no reason to bet anything big right now at this point. After today's big move, let the dust settle. I'm giving you the levels. Now, one more, the S&P 500, SPY. I was covering that earlier today, and we were sitting on my, we were just coming off my third target, which was just hit. Boom, one day, look at that move right there, 10.5% on the S&P 500. But where to? Right back to, let's go to the daily. Look at that. Look at that. Nice resistance right there. Here's that trading range. We broke down, divergent high, major sell signal on the primary trend line break, better sell signal even yet, or additional when the 200s were taken out. If you missed it, you had a golden opportunity to short the kickback to the 200s, just like we did on every rally in the last bear market in 2020 and the ones before that. I've highlighted that many times, going back to the 08 bear market, 07, 09. There again. And so that's that trading range. And this is TA 101. We've come back to the trading range one single day. So yeah, it is an objective time, in my opinion, to either, probably just start scaling, or if you want to go all in, aggressively, just have your stops placed somewhat there. If you're holding out for the prize, again, when I say holding out for the prize, I'm talking about my long-term targets, which are still way below us on both QQQ and SPY. And so this could prove to be a one-day wonder, or not. We'll see. We'll see tomorrow. Okay, now let's talk about, I view my analysis, trading the markets, trying to navigate the markets, 99% of, well, not even, probably 80% of what I talk about here is technical analysis, meaning charts, but I do often inject my fundamental thoughts on the bigger picture, fundamental things going on in the economy. And, so right now, all eyes are focused on Trump and China and the trade wars. I make a lot of predictions, and one of those is that we're going to be rolling into recession. The recession odds have gone up even more, in my opinion, based on this drop. Consumer confidence, people are rattled. This is a shot. People aren't going to forget about this. If markets turn around, exploded higher in the next couple of weeks, made new highs and kept going, sure, of course. That's not going to happen. I don't think it's going to happen. And if it does, then hopefully I'll adjust accordingly. But what's going to happen is there are a lot of folks that now realize, especially newbies. I've traded through many market cycles, going all the way back, for the dot-com bubble and all that, and in my adult life, not just what I've lived through. 1987 Black Monday. I was a teenager then. But I'm talking where I had skin in the game. I was a stockbroker during the dot-com bubble, leading up to and through that whole thing and after, and financial crisis and all that stuff. So financial crisis, I had just moved in. Decided to give up that career of being a financial advisor to chase my passion and love of trading. So I became a full-time trader right before that financial crisis started. So where I'm going with this one is, well, there's a lot I want to cover here. First of all, again, I'm showing you objective levels now, and that's what I just spent my time doing, showing you that we, in just one fell swoop, we've jumped back to some very good resistance levels that I would be surprised if they didn't come into play. So therefore, everything I do is calculate on probabilities, risk reward. So shorting here, if we run up another bit to the 200s, and again, if I'm going to speak to the long-term swing and trend trader. We're likely to stop anywhere up from here, where we're at right now in the SPY, up to, and I'm going to measure it. I'm going to grab where we're at, where we closed today. Up to the 200s would be it's only about another 3% to the 200 exponential moving average. That's the red line. Hopefully you can see it in the video. Here, I'll turn everything off right here. And then from where we're at now, where we closed today, up to the 200 simple is about 4.4%, 4.5. And that's also then takes you to this resistance level right here. You come across here, you had that low, you had the big gap there. There's where we broke down, there's where we back tested. So yeah, so we're looking at not much more upside. So here it is, guys. You're hearing my voice. You're hearing me say it directly. This is a good time to start scaling back short. This is that, reminds me of that scene from, Saving Private Ryan. For those of you who might remember the initial, the landing on the beach at Normandy. The guy and he's, they're in the bullets are flying, and you get one of the U.S. Soldiers gets a bullet and bing hits his helmet, ricochets off, and the guy next to him looks at and calls him, "Wow, you lucky son of a bitch." And the guy's holding his helmet in his hand, just kind of shocked that a bullet just ricocheted off his helmet. And the next bullet hits him right between the eyes and kills the guy. And that's kind of what you may see here, where a lot of folks think they dodged the bullet and then boom. So could happen tomorrow, guys, or it can happen months from now. I don't know. We'll try to. I just want to say the levels to me are more significant than the timing of when it's going to happen. So that's it. Now let's turn to where I wanted to go. Okay. So all eyes are going to just talk about the trade. I turned CNBC off the minute I confirmed what it was that made the markets move, which is going to segue me into DJT in a second. Yeah, let me do that. Let me get DJT out of the way, and then I'll cover the fundamentals, things I'm watching. I'm not a social media guy. I opened a Twitter and Facebook account years ago for Right Side of the Chart just to get those, names. I don't tweet out, just so you know, and it's not my thing personally or business wise. I trade. That's it. I could probably make 10 times what I make on this site easily if I focused on running a site is my primary business. Getting back to customer, I just don't do much. I don't have any employees. I just do this because it's my passion. The site kind of helps fuel that passion. It lets me convey my thoughts. It's just as helpful to me to do these videos and study the charts and know that I have subscribers to, that want updates. So it keeps me kind of buried in the charts, even times I might normally want to take a step, take some time off or whatever. With that being said, I'm not a big social media person, but I do have a friend of mine, that's from my youngest brother. He's just always forwarding everything that's coming in from the internet, news and silly memes and all that stuff. And so I've asked him lately, hey, let me know if you get anything. And he follows this one, of course, all of them, Trump's feed. And you all know he started his own True Social or something, and that's owned by DJT. And so here's the thing, guys. Here's where I'm going with this. I know I'm rambling, but I'm watching first of all today the markets closely, obviously. Waiting to see if we can get a reversal. And this started happening here. And I knew something was going on, whether it was fake news or not, and just waiting, knowing that I've been, like I said, waiting for that tweet, that headline to come out. Let me start building positions. And I'm watching it go up, and I'm watching the reporters on CNBC and the anchors kind of confused. They were covering something else at first. They started to address, hey, the markets are moving. We're looking for the reason. And it took them a little bit. I don't know exactly where it was, but it wasn't here. It was here to finally confirm it. So I guess, a lot of people haven't taken, especially the mainstream media, other than Fox News, hasn't taken Trump very seriously. Typically, generally, the mainstream media leans left, and they don't care for him, And I'm not going to speak on CNBC's particular, but they must not have had anybody following that. And that surprises me that they didn't get that the second it hit. That is from Trump's feed. It's Donald J. Trump, whatever, the official, and he posted that out. And it took them a minute to pick up on it. So where's my point now? How many people you now see the importance, because every little word coming out of the president's mouth or change in policy has nothing shy of potentially explosive news on the market. Huge gains to be made or lost if you're not. So I'm going to just say, it stands to logic more and more people might start joining what a True Social or whatever that is, Twitter-like platform is social media platform. Because if you don't, you almost can't afford not to. I'm just drawing here as I'm looking at QQQ. You can't afford not to right now when stuff like this hits that can move the market so fast. So therefore, DJT is the holding company, and you can see a little setup. First and foremost, I never buy anything if I can't make a decent technical case to do it, and you can. Positive, aka bullish divergence, right there, divergent low, nice move up today, right at downtrend line resistance. So I'm sharing this as a trade idea as well. If it pops this, you can see my targets, 1, 2, 3. That's an old level here. That was resistance. That's not a target right now. My max target at this point in time, it would help, obviously, if the stock market holds up, is about 28.80, which would give it another, if hit, about another 41%. It was a nice move today on that. And again, it's that logic that like the guy or not, and I know a lot don't, if you are actively trading the market or even an investor, it may behoove you to know what he's thinking and doing. Crazy that this is even allowed and legal in some shape or form or another, that but it is, and it's there. So anyways, do what you want with it, guys. Just wanted to share that. Okay, let's turn my focus to the macro. So big moves in the market like this, if I had to poll everybody right now, if this was an open forum, I'd show of hands, how many people think that this drop in, I use the NASDAQ because that's where most people have a lot of money lately in the tech heavy. They have NVIDIA and Microsoft and Apple and Amazon. How many think a 26% drop is net bullish for consumer confidence? I'm going to say very few hands are going to go up, even though we've regained a good part of it today. Again, most of where my bounce started, there it is, guys. Shit. I didn't realize it. I was 2 days ago, since last week, what was I calling for? A max bounce of about 16%, right? It's exactly 16%. It just hit me now that I forgot. We went a little bit lower before we broke out of the trading range. And there's Monday's low right there. And so far, that's it. We got that 16% bounce. So like I said, that was my preferred, kind of target zone. I'm open to more. But okay, now on to the next thing. Again, to me, navigating, especially fast, rapidly developing and changing landscapes fundamentally in the market, macro, the bigger picture, economics, fundamentals. It's like a chess game. And that's what I do on this site. That's why I call it right side of the chart, because I'm not concerned. I use what I see on the left, everything. If this is, most charts I move over, I like to have a little space there. But this is what a chart, anything to the right of price action is the future. Anything to the left is the past. So I take what happened in the past, that's technical analysis, looking at the chart, to kind of predict where things are likely to go in the future. So everybody now is focused on the trade wars, or at least the temporary abatement thereof right now. But this is net bearish. Okay, the last consumer sentiment survey came in really bad, and I can't imagine in the last the next one will come in any better. So therefore, I think the next thing is after this giddiness subsides, the market will turn its focus to the economic picture. So we're going to talk on that real quick. So you have the economic calendar. This is available on right side of the chart. You just go to, let me close that out, go to resources right here. Tools of the trade. I access this all the time. During earnings season, you want to click on this earnings calendar. Right now and going forward, you want to click on the economic calendar. Today is Wednesday, so tomorrow we have CPI and jobless claims. For those of you, and then you can see here PPI on Friday, the Fed's preferred measure of inflation. CPI is widely held, most widely held measure of inflation, and that's everything. That determines whether the Fed, how much, if any, room they have to cut rates. The Fed, Powell, and all his predecessors before him, as long back as we can think, have been inherently dovish. They figured, when the financial crisis hit, we just keep printing money, quantitative easing, zero rates. Why? There's no chance of inflation. That's all the textbooks were wrong. You could print all the money you want. It's not inflationary. Well, that wasn't the case until it was finally. And so we know where we're at, and we know Powell's been in a pickle. Market's been crashing, where normally the Fed probably would have come in and done an intermeeting cut recently. But number one, he doesn't want to cow down and look like he's kissing Trump's ring. And number two, the whole talk about the trade wars and these tariffs was that there would be inflationary and further restrict his ability to cut rates. However, he's he tells you he's data dependent. He's going to look at the job market and inflation. Those two things are the main drivers. Well, if we're all betting people. If you're listening to my voice in one way or another, you're a betting person because you're trading the markets. You're actually either swing trading or trying to time the market, even longer term trend trades, right? So, to some form or another, you're hopefully using calculated risk. You don't have to be an outright degenerative gambler. You can take calculated, quantifiable risks. That's what we do here. That's what we lay out. So I don't mean to use a negative connotation when I say gambling. So, but if you were a betting person, and this is what we'll talk about. Let's talk about this. Do you think that companies at this point right now are more likely going forward to increase hiring or maybe pull the lever back a little bit? I can just tell you from a background in fundamental analysis, being a business major, a former stockbroker, businesses right now don't know up from down, left to right. So that's going to undoubtedly cool any plans to hire, and it might trigger layoffs. They might want to start cutting the fat, because what we saw today was two things. We saw a temporary pause on tariffs to all the other countries out there that didn't retaliate against the U.S., and then escalation with China because they retaliated. So that is not, the markets don't like uncertainty. So these numbers are all hindsight, outdated. The jobless claims, the weekly will be more quick, faster, but then over time, you're going to see there's lags in a lot of these reports. I can almost assure you're going to start to see the job market turn now. Jobless claims increasing on a trend, not week to week. I don't care about 1 week, it's a trend. And we've already seen that trend increasing. And then the unemployment rates start to go up. CPI, Consumer Price Index, that is a big one. These are both big ones. Let's talk about that. If you followed me for a while, for years now, I've used a simple but a very effective method of predicting the CPI, and especially when the analysts get it dead wrong. I take DJP. I've done this for years, which is a broad-based commodity ETN. It tracks the IPATH, Dow Jones, UBS commodity index total return. So it's a basket of a diversified basket of commodities, energy, grains, oil seeds, precious metals, industrial metals, soft commodities, livestock. It's all there. I've covered it many times. It's one of many broad-based commodity ETFs. So, and the reason I do this, again, if you're new to the site, is because this is the only closest thing we have to a real-time indicator of inflation prices. Housing, or owner's equivalent rent, is what they use in the CPI, which is basically going to track housing and prices and rents. That's the closest. That's the top component of inflation, but it's such a dated thing. The housing market, it takes a long time when the trend changes for that to be updated, for sales to actually close, for the and home sales, and of course owner's equivalent rent, what they're going off of, home prices. You don't have any type of real-time indicator in the real estate market. The data is going to be somewhat lagged. This, I've always said, especially crude oil being the top component of all these commodity indexes, the broad-based ones, and because crude oil has one of the biggest impacts on the CPI, everything, from cost to commute your car to and from work, airline tickets, fuel is their second biggest cost behind labor, always has been, still is. Et cetera, et cetera, et cetera. So that, and then of course manufacturing goods, products, and the actual products themselves. A lot of things are petroleum based. The computer monitor you're looking at right now has petroleum, plastics in it, and all that. So that's all in here. And so what I've been able to do over the years is kind of predict with pretty good success rate which CPI reports where the analysts were wrong on consensus. In fact, I didn't even look. I know it's tomorrow. Let me see what it is. So click on it. What do they call them? Month over month, consensus of a gain of 0.1% over the prior month. Year over year, 2.6% is the consensus. So I go to my trustee indicator. And remember, there's going to be a lag here too. And I always say, for full disclosure, that when the government surveys they do to price a basket of goods and services around the country, they do it throughout the month, and it's not on raw commodity prices. It's on finished goods. It's not on a bushel of wheat, but it's on a loaf of bread. And yes, there is. So admittedly, there is a lag time there on especially the agricultural. Not so much in the crude oil. That's day to day. That happens much faster. Gasoline prices tend to lag, particularly on the downside when crude's dropping. Gas stations are slower to cut the price of gas, but when crude shoots up, they are quick to go out there and change the marquee on the gas prices on the board. But okay, so look, guys, we've been trending up. This is where commodity prices troughed right here. And you can see they've been zigzagging up. And from last month, this is the average. See, I boxed this in. This is the numbers we're going to get tomorrow are going to be for the month of March. All right. And so if we just take a midpoint, we started the month here, we ended the month there. There's your midpoint, right about on average of where we were last month. So again, by you looking at this, not much of an increase. Maybe they're right on the 0.1, but I would also factor in the lag here because there is a lag. So, in other words, prices have been moving up. Corn prices are higher. I told you wheat's been hovering, but corn and soybeans are up. So we know what happened to eggs. All that's going to be, probably show through. And my guess is going to be a little bit hotter than expected, unless powers that be can try to fudge a number. Again, that's going to be my guess. That will come in maybe a tenth or 0.2% hotter on the month over month, and probably come in a little hotter on the year over year. Which then, what that does, it handcuffs Powell. It just makes it harder for Powell to cut rates if needed, if this market takes another leg down. So we'll see. Hey, and if I'm wrong, goes the other way, the market's going to cheer on a cooler than expected inflation report. I'm just trying to show you what to look for and then how to react. And I also gave you, which I never have a problem doing, my 2 cents. I make predictions. You make enough predictions in this line of work, you're going to eat crow. I don't mind eating crow. I don't trade for effect. I'm not out there on social media. I'm not out there on CNBC. If they call me today, I'm not going to go on there. I'm trade for a living. I trade to put money, in my pocket. And so I'll make the calls. I'll tell you what I think is going to happen and then how I'm going to react if wrong. So there it is. That's what we have tomorrow, guys. And then this is what's happened. Of course, everything just started crashing lately. But guess what? This isn't what's being reported tomorrow. This gets reported. This is April, and April's still working right now, still going. That gets reported in the beginning of June. Or May, I'm sorry, in the beginning of May when the April data comes out. So this is what gets reported tomorrow right here. So collectively, let me go to macro trends. Just look at the macro trends. Great site for charts, economic charts. Go here to go to economy, and let's look at the national unemployment rate right here. I've talked on this chart many, many times in the past, but again, all this bears repeating, especially for new subscribers. This is the unemployment rate. This is why the cheerleaders on Bubble TV, and again, guys, I know I'm cynical. I used to be in that industry. I can just tell you, work for, investment firms. Their whole existence and their profitability hinges on new money keep coming in, the stock market going up over time because they're paid under assets under management. So they need people investing in the market. If we go up to 12.50, if the market, we go into a horrible bear market and we see 10-15% CDs and treasury bond rates, guess what? I'll be putting some of my long-term funds there, locking in. I tell you, a lot of people will be pulling out of the market. So anywho, that's but where I'm going is almost all analysts, the vast majority, have been citing the fact that especially heading into this year. Obviously, they've just changed their calls recently with the big market drop, which I said would be the cause for them changing the cause for the recession, the drop in the stock market, which was priced into the charts. But they were citing the fact no recession for 2025 because we're economies, the job market's on such a solid footing, right? And as I've covered many times, the employment mark, this is the national unemployment rate. I have talked about this, and I don't honestly. I'm confused why these analysts that they're being paid several hundreds of thousands of dollars a year, I'm sure, with these big firms, don't see what I see. It always ends. It's a V bottom. You don't hit the trough in employment. Everything is cyclical, and when everything gets so good, there's nowhere to go but the other direction. And these are V bottom. These are the recessions, guys, right here. These are the recessions. There's the financial crisis, the last real recession. COVID, it was technically a recession, but if you blinked, you missed it. The dot-com bubble, we had a recession after that because of the stock market crumbling. You can see them all, and look what happens. Right before the recessions, especially when you get down to the low end of the historic range, there's nowhere for unemployment to go but up. That's what I've been beating this whole recession drum because it's clear. And instead of everybody being bullish and saying, no, the economy's in solid footing because unemployment's at record low levels, it always gets to record lows and then the recession comes. So, and more importantly, as I've said before in the past, the turn's already in. That's what I don't see. They don't get, not just after the last week or so, not if the numbers come out bad this week, the turn has already happened. And I'm begging you to find a point in history where you turn from the bottom, a decent turn to this extent, not a blip. These are little aberrations. These are little blips along the way down. When you clearly see the turn it's very unusual, if not completely, unprecedented, to see that's not the bottom and then the recession doesn't follow. So you won't hear the recession will not be official. NBER always declares it in hindsight after it started. So don't wait for them to tell you. If you wait for CNBC to tell you or the NBER to officially declare we're in a recession, you've now already lost. We're probably going to be damn close, if not all the way down to my 50% downside targets. So if you wait for that point to start pulling money out of your 401k, it's too late. Either way, this is what I wanted to show you. We've turned the corner here. And so going forward to either reinforce or maybe back off my case for more downside and looking to short rallies, assuming we're in a bear market and we're going to go lower, I'll be watching employment. And if I'm wrong, if inflation starts to cool, giving the Fed some more room to cut, and if the job market continues to hold up, then, from a fundamental perspective, my case is not as strong anymore, right? And these are fluid. They change week to week, month to month, quarter to quarter, depending on the report. I just want to say these are things that I'm monitoring and closely going forward. And then just like the stock market, remember I warned the selling when you go into a bear market or correction, the reason I love shorting stocks is stocks fall a lot faster than they rise. I've always said it's normal in just weeks or months to wipe out many months or years of preceding gains, but you got to be fast. Now, the same thing happens once the job market turns, it starts to accelerate very fast. And then again, if you wait till this point or this point, then most of the easy money on shorting the market has been made at that point. All right, that's it. So I think I'm going to stop here. The point I tried to convey is I think the whole world, most of the world's watching and focus on the trade wars now. It's a 90-day pause. China and U.S. will do its own thing back and forth, and there could be something comes out of it that's not good, or you could see positive news there that further adds to a rally, but you could also see things go the other way. China has a lot they can do, and they're not a very peaceful, passive, the government there. So, and Trump is just the way he's framed it for them. He's not giving them any outs. And I don't think I don't see how that's going to resolve itself well. Doesn't matter. Let's let the charts be our guide. But again, why everybody else is focused on, for the time being, the trade wars, let's watch the economic indicators. I predict they're going to go down. I think the damage has already been done. I think you'll continue to see this is a shot across the bow for those people that wrote it out, put their head under the sand. I'm talking typical investors, 401k people who've now seen their beloved Apple and Nvidia and everything else bounce back quite a bit. I think there'll start to be a lot of profit taking along the way, especially for those who are too top heavy in these big names, these big AI poster child stocks, Nvidia, SMCI, and the likes. I still do like Bitcoin and Ethereum I put out there. I did lighten up, and I knew they'd rally with the market, but I lightened up on everything today just to reduce exposure. I've been through these cycles before. Today was my biggest dollar gain ever, and from my experience, after my biggest, some of my biggest dollar single day gains have been followed by my biggest single day drawdowns. So I over the years I've gotten in, just kind of instinctively know when to push it, because sometimes I'll have a great huge one day gain and then followed by another even bigger. So it's not just the fact, hey, every time I have a big day, take out. Today was a day that tells me, boom, grab those profits, lock them in, go to mild short position, but a small fraction of what I was long coming up to it, because of, again, the uncertainty. It wouldn't surprise me one bit to see them follow through on this and not give me that little pullback I'm looking for right away. So that's my kind of my trading plan, guys, or my mindset right now. I'll wrap it up here. Certainly keep the updates coming right now with the volatility still being high and opportunities tremendous, because again, when the VIX does this, VIXY is our official trade, when the VIX does this, when it wakes up like this is when traders make money. This is historically, these are the periods that in a matter of days or weeks you can make, I as an active trader can make more gains than I, in a slow grinding market if there's no other opportunities elsewhere. Remember, natural gas was one of my most profitable trades last year and into this year, well over 100% return. So there's other things out there. I'm speaking now just to the stock market. And again, this is when traders make money, but this is when they can also lose money very, very fast if you are not nimble and flexible. So stay safe, guys. Trade within your comfort level, your experience. And remember, when volatility is high and daily swings are now up to as high as 20% a day in the indexes and the NASDAQ, you don't have to invest a lot or be exposed a lot to make a pretty decent profit. Bulls make money, bears make money, pigs get slaughtered. So good luck to everybody. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart.